And finally, Tiffany Company has reported that its fourth quarter profits have slipped. The lower than expected earnings broke a 5-quarter streak of better than expected results for the upscale jeweller. Well, despite the drop, most luxury goods retailers say the forecast for 2012 sales is optimistic. Our correspondent Karina Huber has more.
Tiffany is a gem among retailers. For 5 consecutive quarters, the company topped earnings expectations as customers were lured in by their glittering offerings. But their winning streak has just snapped. Sales during the holiday season were a disappointment, and profits overall for the last quarter also failed to impress. Experts say Tiffany didn't offer enough new products and were hurt by watches outshining jewelry as the bauble to buy over the holidays.
During the holiday season, watches was one of the top performing categories. At Tiffany, watches represents about 1% of their sales in their own retail stores, versus some of its peers like Richemont, where it represents north of 40% of their business.
The past does not equal the future, though, and the company is betting last quarter's trend will not continue. That caused Tiffany's stock to pop.
It won't be long before shoppers in the United Arab Emirates can walk into a store just like this one and come out with a little blue box. The company is making its first foray into the region this year. Overall, the company is bullish for 2012. It plans on opening 24 new stores, many of them in Asia, and it expects global sales to rise by 10% this year.
Luxury sales overall are expected to be strong in 2012. Neiman Marcus, Saks, and Nordstrom have all reported solid revenue gains in the past few months.
The reason why luxury trends are still healthy, is because the macro environment is improving. Unemployment, in the U.S. is declining. The stock market, is back up to relatively healthy levels. Consumer confidence, has strengthened over the past year.
But if luxury retailers want to keep growing their pool of customers, they're going to have to adjust to a more fickle clientele. People in their 20s and 30s are less loyal to brands than baby boomers, say experts, and so customization is going to be the name of the game going forward. Karina Huber, CCTV, New York.